Thank you, everybody, for joining our September Landowner Insights webinar. This month, we have the distinct pleasure of having Dave and Katie from Strategic Farm Marketing and Crop Insurance to join us. And we're going to dive into crop insurance, and we're going to try and put it in the context of how it impacts farmland as an investment and how it creates some opportunities. And I'll give everybody a little bit of a warning. Crop insurance is complicated, and we're going to have some fun diving into some details, but we want to make sure and help everybody understand how impactful crop insurance is for farmland values and income protection. And so first thing I'd like to do is just let Dave and Katie introduce themselves in strategic farm marketing just a little bit.
Yeah, thanks, Dave. And Strategic Farm Marketing, we're based in Champaign, Illinois, and primarily a crop insurance company. We do some grain marketing on the side and deal with the futures and options markets, et cetera. And really what we're trying to do is help landowners, investors, individual producers manage the risk around production agriculture. And of course, one of the key tenets of that, and really the first building block of that, I'll say, is kind of understanding and implementing the crop insurance process. And for a number of different reasons, crop insurance is adapted in a big way. And I'll just we've got about 90% of the acreage in the U.S., the farmland acreage, that's actually participating in the crop insurance program. And so, Dave, I don't know if you can see that slide on your screen or.
Yeah, that's
Yeah.
excellent. And giving the crowd just a little bit of a background on what we're going to throw at them today. We want to give a little bit of a primer. What is the crop insurance program? How does it work? How should you think about that as a landowner? And then, Dave and Katie will help dive into some of the specifics and thinking about how it protects both your land value and the annual income. And then we want to talk to the landowners in the group a little bit about how they might think about it from an opportunity standpoint. Certainly, one interesting option for landowners is thinking about custom farming and owning the crops themselves. How does crop insurance actually protect that income on an annual basis and potentially create some of the upside that can come from that? And so that's a little bit of a primer on how we'll step through. And Dave and Katie, you'll give us some really good examples as we start to work through that. So sorry to interrupt you, Dave, there, but wanted to get everybody primed on what we're going to walk through a little bit.
Yeah, Dave, no, thanks for laying that out. And let's just dive into it a little bit here. We'll make good use of everyone's time here. And as I kind of talked about, it's crop insurance kind of, we farm ourselves, and we've been in the agricultural industry for 25 years or more. And so it's a situation where looking at how we're going to manage risk, whether it's around commodity prices, whether it's around production agriculture and the input costs, crop insurance becomes that first kind of pillar that we look to every season. And just to point out here real quick, and I'm going to use the cursor here, you can see that this is the percentage of acres in the U.S., the farmland acres, that are actually participating in the federal crop insurance program. And you can see that as of last year, that number was north of 90%. So 9 out of every 10 farms, or 9 out of every 10 acres of production agriculture in the U.S. is utilizing some type of federal crop insurance policy. And if we start to ask ourselves what kind of policies and why and what kind of crops, this is just a very kind of, broad spectrum way of looking at it. We've got row crops, specialty crops, livestock and animal products, forage crops. And so you can see a vast majority of that kind of pie, if you will, goes into the row crop situation. But it's also, these products also apply to specialty crops, to, things that are outside of the normal corn belt and different things. And we can dive into that a little bit deeper as we go here. But looking forward, when we talk about crop insurance, Dave, I think he mentioned that things can get very complicated very quickly. And unfortunately, that's the case that we're in. We can make this product as simple and kind of, rudimentary as possible, as we would like. And we can also make it almost as complicated as it can be. But when we look at the different types of insurance that are out there, we have what we call individual insurance, which is revenue protection. You can take that at an 85% level. We have purely products that are based only on the county performance, not the individual farms. We can combine the two of those. We have a creature called margin protection. So all these are different ways of combining your structure. But when we look at what's actually used and the policies that are in place, by far the biggest policy out there is what we call the individual revenue or the revenue protection plan. And you can see it down here highlighted in the red, and kind of what a bigger piece of the pie it is here in terms of the different types of policies that are utilized by producers, by landowners out there in the US currently. So let's maybe focus, Dave, if we can, just on that kind of revenue protection product, if you will. And revenue protection, or RP, is kind of the most common underlying plan of insurance, as we talked about. And really the key thing to understand here is that when we say revenue in terms of protecting our asset and our farm, it really has two components. It has a yield component as well as a price component. And so what happens is that we have a yield, history that's established that becomes our, in effect, yield guarantee, or what we call APH in this particular case. And then we have a price component that's determined by, there's a spring pricing window in February and a fall pricing window in October that use the Chicago Board of Trade and the futures values for corn, beans, wheat, et cetera, to determine what those prices are year in and year out. And we know that there's volatility in that situation. But the key in terms of what it does for risk management and for a producer is that it establishes this minimum revenue guarantee that the farmer can look at. And so any combination of either a yield decline or a price loss that puts that harvest revenue guarantee below the revenue guarantee results in a claim. And so there's two ways to kind of approach that and go about that. You have two moving pillars, if you will. So if I kind of put some numbers to that, Dave, and try and give a feel for it. So this is a revenue protection example. We're going to use this as a corn example here, but all we're doing is taking that farm's approved yield times the coverage level of the policy, and then our ultimate revenue guarantee is either the higher of the February, the spring price, that's our starting guarantee, but we also have the option of seeing that guarantee value go higher if prices have moved higher in the fall. And so in this particular case, when we look at a farmer, we're going to use a 230 example, 230 bushels per acre on corn. We're going to use an initial spring price of 475. And this is how you get your guarantee level. So on your yield side, 230 times 85% of that value, you have an implied yield guarantee of about 196 bushels per acre. If you fall below that, you're obviously in a situation where you can trigger a claim. On the revenue side of that, we take that same yield guarantee times the spring price that's assigned, and it comes up to a revenue number. And this is the really important number. In this case, 195.5, and that's your bushels per acre, times $4.75, which is the spring price for corn, results in a revenue guarantee of $929 per acre. And of course, that's the key to this policy, is that is covering, hopefully putting you in a position to cover, all of your input costs, a little bit of profitability along the way. These commodity prices vary, and these insurance guarantees change with every, literally every farm in the APH and every year with the price changes. But we're trying to get ourselves in a position where we have a very good revenue guarantee against a yield loss or against a price decline, in terms of covering our operational costs on these farms, and in times ensuring ourselves a profitability. So if we do, let's just say two quick examples here, Dave, and we look at a situation based on the yield and the revenue guarantees that we have here. Let's say that yields decline here. And typically when yields decline and we're in a situation where the crop is getting smaller, we often get a situation where prices rise with that. And so keep in mind, you got the two prongs here, the revenue and the yield working together to get to that final number. So let's say that our harvest yield drops from, we had a 230, APH, we had a 195 guarantee, we have a final ultimate yield of only 180 bushels an acre, but the price has rallied to $6. Even though this price has rallied, if we take the calculation in our revenue calculation, the 230 times the 85% times $6, we're now at a revenue guarantee in the fall of $1,173 per acre. When we look at what we actually had, we had 180 bushels worth of production. We had a $6 fall price, and our revenue fell short of that guarantee at $1,080 creating a $93 per acre claim. So that's the claim that goes back to you. Your yield has come down, even though prices have gone higher and your revenue has actually gone up per acre. The guarantee, we're still creating a claim in that situation off of the crop insurance. It can work the other way as well here. If prices fall, let's say in a year like maybe similar to what we're seeing this year, but yields are near average. In this case, we have a harvest yield of 220. We have a harvest price that instead of $6 is $4. So in that situation, we're going to stick with our original 475 price. Our spring guarantee holds. The fall price was not higher, and our revenue guarantee stays at that 929. But in this case, our actual yield in that crop year was 220 bushels an acre times the $4 in actual of price, and our actual revenue was $880. Again, below our guaranteed revenue, so creating a claim in a sense where prices have fallen and yields have been pretty stable. So hopefully that gives you a feel of kind of where we're going from the value proposition on crop insurance in terms of how it protects you against the things that you want. And this, like any insurance policy, I think, Dave, when you put on a crop insurance policy, really claims are not what you're after. What you're after are high yields and high prices. And in that situation, we don't need the insurance product. That's kind of akin to, look, I paid insurance on my house, but it didn't burn down and I didn't collect any insurance. But in this case, we're able to manage that risk and do so inside of this policy. And Dave, this is a slide that you put together, looking at, kind of the cash rent comparison. And so I'll let you kind of run everybody through this quickly.
Yeah. A couple of notes as you've gone through there, I think that are good to call out. We always like to tell folks that farmland is the only investment grade asset class on the planet where you get a annual revenue guarantee, a minimum annual revenue guarantee from operations through a insurance policy that's subsidized by the federal government, right? It's truly an incredible outcome. They're just having that farm operating, whether a landowner is leasing it out to a tenant and they're carrying the insurance, or potentially if they own the crop themselves and do something like custom farming, like we're walking through here. There's an annual guarantee in revenue from operations, and that's really substantial. And one other thing that I think is useful to point out to folks, we're certainly going to spend our time going through examples that are pretty Midwest row crop focused, and that's where there's some pretty robust policy structures that have emerged. And you guys will talk just a little bit, I think, Dave and Katie, about the private product stacks that have emerged on top of it. But when you saw one of those charts earlier from Dave, it was interesting to point out that these policies are in place for a wide range of crops, right? So you can head out and see tree nuts and tree fruit and fresh market crops. And there's interesting sort of ancillary coverages when you get into some of these other crops around crop quality, right? If you have weather events that maybe impact the quality of your fresh market potatoes, as an example, there's quality components to some of the insurance. And one of the key messages that we want to talk to folks about is thinking about upside opportunities in a custom farming example. So for landowners that have an interest in having some exposure in the commodities, what crop insurance can do is put a hard cap on your downside while letting you have some of those inflationary upsides that come with farmland. In this case, it's just a really simple matrix. It says, hey, if I have a farm that I've been renting out for $325 an acre, and I'm thinking about custom farming it, what is the downside versus upside comparison? So if we make a few assumptions, the cost of production is $600. Your yield, actual production history is 215 bushel an acre. You go with a simple 85% coverage like Dave just highlighted. Now you've got a yield guarantee of 183 bushel. And then if you put that against a range of actual yield outcomes and yield prices, then you can sort of see a big chunk of this chart, you're actually making more than your $325 an acre cash rent. And there absolutely is downside in certain cases where if prices and yield go down. But at the same time, we are protecting at least that base level of net income. And so this is something that we certainly talk to landowners that have shown some interest or expressed some interest around having some commodity crop exposure. That crop insurance is a really important tool for being able to help them make that plunge into grabbing that exposure and potentially capturing some upside. Hey, Dave, I wanted to ask you one question. It was sort of interesting when you looked at the chart on the different kinds of crops and agricultural production that are being insured. I saw a fair bit of growth in the livestock arena. Do you guys have, I don't think you do a lot in the livestock side, but do you have a little bit of background on really what's been emerging from a livestock and animal production insurance standpoint?
Yeah, Dave. So it's been one of the bigger growth areas in terms of the overall crop insurance pie. And I can't quote off the top of my head the specific, policy, liability or premium dollars, but it's been growing leaps and bounds. And they operate in a mechanically in a very similar way to what we find with an RP policy for corn, beans, or other crops. In other words, there's a reference price, there's a period, and it has a federal subsidy. And a matter of fact, in most cases, the federal subsidy is at a higher level than what we find on the row crop or the grain contracts. Those are referenced off of USDA published indexes for fat cattle, feeder cattle, live hogs, and the different segments that go through that. And there's different ways you can pick different, weeks and coverage periods and how far out you're going. One of the things that we find that I think attracts producers to it is it does have a high subsidy level, and so it's a good put, if you will, or that protection level, that same thing that we talked about in terms of covering your basic costs or covering your revenue outlay and hopefully some degree of profit. But it's also available when you talk about crop insurance, and we'll talk about this as we go forward. There's certain times of the year you're putting a crop insurance policy in place in the spring, and you're kind of living with that through the season. In terms of the livestock and the LRP products, you're able to essentially take any amount that you want on any day that you want and for almost any period that you want looking forward. So if you want to do one lot of cows today and you got two pots tomorrow or two pots next week and you want to look forward and you've got some that are going to be ready, at the end of March, and you've got others that aren't going to be ready until April or to May or till June, you can really customize that coverage. And certainly that's part of the repertoire that we see. And being based in Illinois, we're not in a huge, we're not in the middle of feed country day, but we have customers who definitely utilize that. And when we talk about the Iowas and the Minnesotas of the world, the hog component of that is very vibrant, if you will. So
the other thing I
Yeah.
was going to mention as well is part of the increase in LRP, specifically in this last 3 or 4 years, is specifically due to a subsidy change. So they did go through and increase a lot of these subsidies. I believe it was 4 years ago now, for these livestock risk protection plans or LRP plans. So that's really gained a lot of attention, as well as they've reduced some of these minimums. So you really can just insure one animal if you wanted to, making it very easy for producers to give it a try. And so I think that as people have given it a try and they, understand the program and it's working well for them, it's gained a lot of attention and a lot of traction with just being a kind of a cool and unique product in the insurance industry.
Yeah, and I know it's time for us to nerd out just a little bit more and actually talk to the landowners listening in on how this works for them, whether they're leasing or thinking about some exposure in the crop themselves. But that conversation, I think, is useful to bring up. The crop insurance program has become very well protected within the Farm Bill, and you guys certainly live it in trying to make sure that you can help understand more and more what's going on with emerging new policies and even pushing conservation practices with premium reductions or subsidy increases, et cetera. But I'd be interested if you guys have any comments on that notion of, crop insurance being highly protected and sort of an expanding tool, more so than something that's ever at risk within the Farm Bill and the federal subsidy programs.
So yeah, I mean, anytime we talk about politics and the Farm Bill, it's always a moving target, and we always think we're headed one way, and then we end up, with something a little bit different. But historically, Dave, if we look at a number of different Farm Bills over a number of different years, if we look at the current situation and the strength of what I'll call kind of the farm coalition within both the House and the Senate, and the politics and the way that they shape up, it looks like the total dollars that go into the crop insurance program are going to get bigger, not smaller, as we go forward. And part of that's just inflationary, but part of that is also expansion and new programs that are coming online, and specifically, things that we talked about with, subsidy changes and increasing subsidy, and trying to put, I think, in the government's view, more towards the crop insurance and less towards some of the ad hoc, disaster programs, if you will, and into more of a structured feed. So certainly, we're in an election year this year. Anything is really, I guess, on the table after what we've seen here of late. But having said that, there's a pretty high confidence level that we may not get a farm bill here, a new farm bill in the lame duck session, but we'll certainly get one after the first of the year. And in doing so, we're looking for the crop insurance coverages, the subsidy levels, and kind of the offerings, if you will, to become more robust and not less.
Mhm.
You bet. Well, I think if you guys want to start talking to the landowners listening a little bit more on, hey, how does this work? How do we implement it? How does it impact your farmers, and get into some of those more specific kinds of outcomes, that'd probably be a good next piece of the conversation.
Yeah, so we kind of, we left off here where we were talking about this is how an RP policy, and then this example for corn basically works. We could substitute a soybean price, a wheat price, et cetera, and the mechanics of the policy are going to work the same way. But let's maybe take that a step further here and kind of like, let's look at it from, an owner's or investor's standpoint of what's the value proposition of crop insurance in terms of running that operation, or maybe taking on that operational risk of a custom farming operation versus maybe a cash rent operation. And the first thing here is, just what we've been kind of hitting on here is that it assures a minimum level of revenue or income to the farm. And so whether we are in maybe it's a prevent plant situation, whether it's too wet to plant your crop and you don't get it out, maybe it's a yield decline, or maybe it's simply that the board prices are falling and commodity prices are getting cheaper from the time that you plant the crop till the time that you harvest the crop. We have a product here that's federally subsidized that, from a bang for the buck in terms of cost that you can buy. And as you put it, Dave, the only, industry asset that we can talk about that has a guaranteed amount of revenue with it every year, for an identifiable premium. That's really what this crop insurance product is about. And when we take a step back, we have to, draw kind of a comparison between, there's a couple of different types of crop insurance. One is what we call the federal product. And when we talk about anything that's subsidized, it's subsidized through the federal government. So those RP policies and the examples that we just showed you, like in this case, or these situations, these are federally subsidized policies. There's also a private component of a whole different level of add-on or over-the-top coverages that will allow you to do different things. So some of those cover just simple things like wind or hail. They could cover things like fire, vandalism, the quality of your grain, et cetera, all that give you, the assurance that, hey, if we have a problem and our revenue is going to suffer because of it, we have some backstop to that inside the policy. And as I said, when we talk about those private products, they can also do different things. They can take you to a higher coverage level. A federal policy will take you to 85%, but we can, on an individual basis, but we can look at a county product or a private product that may take you from 85 to 90 or even 95% coverage. And there may be reasons to do that or not to do that. There's certainly a premium adjustment for the higher the coverage or the smaller the deductible, if you will, the more the premium that we have. But I think what it comes down to is that, when we look at the federal policies, they are very advantageous here simply because of the premium cost and because they're subsidized. When we look at the private products, we find a whole different can of wax where in a number of cases, the premiums on those products are priced below the effective loss ratio of the product. And that's kind of that loss leader concept. In other words, it's an attempt by the insurance provider to say, hey, we want to get your underlying federal policy, and here's what we'll give you as that carrot or that apple to kind of come our way. And that might be a very affordable replant product for, $70 of replant, let's say, for $2 an acre or $1 an acre, something like that. So there's a number of different ways to do that. But what you find in the end is that when you kind of combine all of these into one, what's the best for me scenario, you have a lot of choices. And so I think that's where it really becomes key to be working with somebody who understands you as your operation and what your needs are, what your budgets are, what your goals are, as well as what the available insurance products out there are on both sides of the aisle, the federal products as well as the private products, and how those are combined to get to the best, premium versus coverage scenario for you as an individual owner or investor. And so when we look at that, let's just break that down in a minute so we can kind of quantify what we're talking about. If I talk about these subsidies, and I've been mentioning them, let's just look at what they are. So typically in a crop insurance, in the core of the Midwest, we're talking about what's called enterprise unit, where the farms are combined. So you might have these farms, all kind of combined at the end of the day, but the subsidy levels on those coverage levels, we talked about an 85% coverage level. 53 of that percent of that actual payment or that actual premium is paid by the federal government in that case. So you're buying that product at a 53% discount to what it would be priced the fair market value without that subsidy. In the case of an 80% policy, that subsidy jumps up to 68%, 75% policy, it's as high as 77%. So that's the first clue of, hey, this gets my attention and what it means. And, what we can do in certain instances is move this lever around a little bit on this scale from left to right. And maybe we'll drop our coverage from 85% to 80% so that we can take some coverage that may be at 90 or 95%. And the subsidy levels on some of those products have changed as well. They're now 65% to take you to a 90 or 95% level. So it's a way of how you combine these and how you maximize those subsidy dollars to your benefit. So there are ways to get your crop insurance above that 85% level. And we can do that in two ways. One is a county-based program. That's your ECOs and SCOs, if you've heard of those. Those take you anywhere from 86% up all the way up to 95%. We talk about private product offerings. It's a number of different ways to get there, but they allow you to get to those higher coverage levels as well. In that case, their rates vary. They vary quite a bit or heavily by the different producer and his farming operation, as well as the different insurance providers that are out there, Dave. So having the ability to kind of be able to look at that and look at all those choices is very important. And the higher these coverage levels and the plans go, in other words, if I can get your coverage level from 80 to 85% or from 85 to 90 or even as high as 95, what we're doing is mitigating more and more risk along the way or guaranteeing more and more revenue along the way. And we'll kind of get into that. We'll do a real world example of kind of how that looks. But just keep in mind that insurance elections are made by crop by county, and the idea here, though, is that they can be customized. You don't have to take the same coverage in different counties. They may be side by side, but you may want, one coverage in one county and a different coverage in another county. You may want one coverage on your corn crop, a different coverage on your wheat or soybean crop, et cetera, and being able to combine those. So here's maybe a graphical representation of kind of how that looks. And we've got our individual coverage here at 80% on the block here, the block here in the gray. And then we're taking our coverage up in this situation into an 86 to 95 and taking it all the way up to 95 with some of these individual or these offset products that you can do. And we'll talk about the costs that are in that situation, but it makes sense for some producers. It doesn't make sense for others. But if you look at the matrix right here, Dave, this is really what we're after. In a situation where we've instituted this type of a policy and this type of a structure, in a situation where you've got both county coverage and individual coverage in this scenario, where county yields go up, but your individual yields go down, you can claim because you have an individual policy. In the situation where county yields are down, but your yields are up, you can claim from the county side of the policy. county yields are down, individual yields are down, you're going to get the better of either one of those scenarios. And this is the situation that we talked about where the house didn't burn. If the yields are up in the county, your yields are up on your individual farms, certainly then, you're not claiming, but hopefully it's a very good revenue and profitability year for you in that situation. So there's kind of ways to do that. Well, I think I'll save this slide, excuse me, for, talking about the premiums and where we go. But the other side of that is covering some of the risks that aren't included in the federal policy. And those are these supplemental crop insurance offerings that we talked about. And you can see here, we've got hail coverage for hail that might result in your fire. We've got wind and green snap coverage. We've got replant coverage for when you have to go and replant a crop for a second or a third time. Extra harvest coverage for when you have to use it. Maybe, it's a slow harvest. You have to go one direction. You have to use a reel, etc. All of these can be kind of mitigated to a certain degree, depending on how you want to do it. And we do that by looking at a number of different, scenarios. In our particular situation, we look at 8 different insurance providers, and all of their rates can be different for different reasons and different parts of the country and different crops, etc. So when we, maybe just to give you a feel for that, Dave, I mean, these are wind and hail bundles from 2 different companies, NAU and RCIS. And you can see in this case, we've got $1,000 of hail coverage per acre. We've got wind with an excess 5 deductible here, and we have $75 of replant included. That particular coverage from this provider is $1.26 an acre, or on 1,000 acres of corn is a total premium of $12,600 for just that component. If we look at maybe the other side of the spectrum here, here's $1,000 of hail. We do have a 0 wind deductible, but we've got the same $70, and we've got $70 replant instead of $75. But this company is offering that same product at $2.60 per hundred, or that same 1,000 acres of corn turns into almost 26,000. So more than double what we've seen from this. And we'll show you this in a live quoting situation here in just a minute, but it gives you a feel of, I don't want to overwhelm you with 500 choices on crop insurance, but I also want to make sure that you're not working with one person who just looks at one company and one product. You need to have a broader view of the marketplace, and the tools that Peoples is developing, the land managers are using to help you get to this, and this decision point. We need to make sure that we have full access, and that's certainly our goal here and what we're putting in policy in front of them. I talk real quickly about, what's required of someone, an owner and investor that's going to enter a crop insurance policy. There's a couple of different ways to look at that. One is certainly that, we have to make a policy selection decision for the new crop year. So for the 2025 crop year that's upcoming, we have until March 15th to put that coverage in place. And we don't even have the rates out for those particular policies yet, but that policy goes in place in the spring for those row crops. For wheat, it's by September 30th. And then we go forward with that through the crop year. And as we're growing, you have an acreage reporting requirement, you have a production reporting requirement. Those are simply just paperwork things that have to be inputted into the crop insurance policy as part of the federal mandate along the way, and doing different things. So keep in mind, there is a little bit of paperwork or administrative work on your end in order to make those work. And so, you've got some quality, things that are covered in your policy as well. I think Dave was talking about things, but if you've heard of things like, alpha toxin, vomitoxin, fumosin, those are, can be very tough issues where the elevator is giving you a big discount. And in most cases, we have some kind of coverage through that with the crop insurance. So not only is it protecting you in terms of revenue and yield, but this is the quality kind of component that we talked about. So with that, I think, Dave, maybe you can guide us, but if you'd like to do maybe a live example, we'll switch over and just kind of show you how these numbers flow into a particular crop for a particular county of your choosing, if you will.
Yeah, so I think a couple of key themes and communication points jump out, right? There's certainly no shortage of opportunities for assembling really strong revenue protection. And as you mentioned, Dave, you can have really simple options, 85%, pretty clean. What the subsidy, what the premium is going to be. It's all right there. But then there's also this broader set of making sure that you're maximizing relative to the scenario. What's your risk on an individual farm relative to the county? How does your operations strategy work? right? Just thinking about where that sits across this wide spectrum. And so, we're working with you guys really closely to make sure we get access to all of these analysis tools that we're going to get a little bit of a sneak peek of here. And I think the core takeaway for folks is that there's some really interesting opportunities, if this is executed correctly, to create protection with these subsidized policies that it just broaden the opportunity for a return from your land. And also even in lease scenarios, thinking about making sure that the operators are maximizing what they're able to protect with the land. And these are a couple of core themes why we wanted to give everybody the background on crop insurance. So I think it'd be fun to maybe dive in and just assemble a couple of test cases where you guys can show how this down selects and then ultimately turns into a program that and a policy, a revenue protection that's pretty appealing.
Sure thing. So let me go ahead and kind of move over to, this is kind of an example of what our kind of quoter looks like as a part of building a lot of our sales tools. So ultimately we use this to evaluate, again, you mentioned the almost indefinite different types of strategies and combinations of different things that we can do to form our crop insurance strategy to mitigate the most risk. But in this case, we really are just entering in the state and county information. We need to know our farmer APH information, which is really just based off of their yield history. And then really we're about squared away to go. And so when we look at, again, this list that has, right now, let me go ahead and reset it. It has all of our different options for federal programs. So this list, we're only in the 100s. We're not even a third of the way through. There's about 700 options of just purely federal products that are on this list right now. So obviously that is way, way too many. So being able to kind of break these down into smaller lists, let's say in this case 26, right, of just depending on what type of strategy we want. We have lots of different options to take some of these buy up county products, these SCO and ECO, different types of plans. But really, as an example, it would go ahead and show us what our yield guarantee would be for, let's say, 85% RP, what our revenue guarantee would be, ultimately what our premium is going to end up at, and then really using 3 different examples of true yield and price scenarios to determine how these products differ from each other. So once again, this is all of the federal stuff. This is the type of products that are the same rate for everything. But there's a ton of things that we can do to add for private products. And I'm going to go ahead and kind of move to that and move back to our profitability here in a minute. But this would be an example. These are 2 different types of add-on products, if you will. But on these private products, we have this whole crazy list of all of these kind of add-ons that we can go ahead and build into our strategy. So in this case, just to, this is just an example here for soybeans, but if we have an 85 to 95% band, this is offered through one of the insurance providers, it would go ahead and result in about $81, or in some of these different cases, even more than that, for, this $33 price point. This is really where we can help evaluate where some of these add-ons, either saying, oh, that's just too expensive, or where is this actually going to kick in? What is this extra, premium dollars? What's that going towards? So really from a private product perspective, this is where there's a lot of competition with price. There's a lot of, variability in the types of plans as well. But kind of ultimately, we take it down really from the side of analysis of being able to see, all right, here's the profitability chart. I know there's a lot going on some of these sheets, but just kind of giving you the kind of keys to what this all looks like in the back. But here we have a profitability comparison on top and on the bottom. Really, this is giving us the option to evaluate 2 different strategies at one time. So on this case, it's looking at 85% RP, again, against having no insurance at all. So this can really help to identify where obviously the insurance is covering you. We can obviously change our costs of productions and, what our forward cash sale prices were to fit the individual producer. But this is where we can say, okay, if we want to take a county-based ECO plan, what's that going to look like on this chart? How is that going to differ from taking an individual plan? What if I decide that I just want to take a really low level of coverage in order to minimize my premium? Where are you at a loss as opposed to spending a little bit more to be able to get the proper, coverage for your farm? So we do a lot of this analysis, really from the standpoint of figuring out what is the value for the dollars that are being spent, and from a visual standpoint to really be able to compare plans back and forth. And then kind of ultimately to sum it up, again, there's a lot of different informational charts in here that we could really get in the weeds with, but we really try to leave this behind, this type of strategy option right here. We could pick up to, 5 different strategies. In this case, I've narrowed it down to 3. But generally speaking, there's so many different ways to evaluate all of this. What we're really trying to do is to say, all right, from, an ABC standpoint, if you want to, just protect yourself and you want to maximize the individual coverage, and maybe that's, 85% RP, what's our cost benefit in terms of our guarantees versus our premium going to be? Say we want to take a county product, something like this, how does that compare to some of these individual plans? And then finally on the bottom, this ECO Plus, for example, that would be an example of a private product. We can see how that maybe changes our guarantees as we go through. Like in this case, that gives us a much higher individual yield guarantee than it would on any of these other plans. But again, it's a little bit more costly. So anyway, it's a way for us to be able to really narrow these down to say, of all of these infinite options, here's just a few different avenues for if you want to, maximize coverage, go this route. If you want to minimize, premium while still being able to have relatively good coverage, I think you generally have different value points for each producer. So we try to narrow it down to prioritize each set of values that you could kind of possibly have.
This is really helpful, and it is complicated. I appreciate you guys sort of walking through this in so much detail. I think there's a few really core messages that we wanted to communicate with the landowners joining us here, right? The crop insurance program is very much entrenched in federal farm policy and the options, right? The strategies, the additional sort of policy features continue to grow, right? And we're seeing premium subsidies even get more attractive, as we talked about just a little bit. Another key point is that crop insurance is really fundamental to protecting farmland income. Obviously, we understand that crop production, regardless of type, is highly sensitive to external conditions, right? Weather and price cycles are certainly going to move around quite a bit. And protecting that income subsequently is a real strength in the trajectory and growth and appreciation in farmland values, right? These things are fundamentally tied together, and crop insurance plays a really significant role. Another point that we really wanted to communicate that, crop insurance can be a big part of a strategy for landowners that are looking at opportunities to get some commodity crop exposure, right? Capture some upside potentially within inflationary periods and high production years while protecting downside income in years where it doesn't go well. So thinking about those custom farming examples or participating in the crop. And, the final sort of key message that we wanted to make sure and communicate with everybody is that there's a lot going on, right? And we need a partner. We work at Peoples directly with strategic farm marketing really closely. They built just an incredible program in terms of their relationships with all the AIPs, and then being able to put together and assemble the right crop insurance policies for a given set of risks and a particular operation, depending on the strategies that come together. Dave and Katie, do you guys have any sort of closing thoughts for the group around, how to engage?
Yeah, David. I mean, I think that's really driven by the customer, but I think what we're trying to do is there's been a lot of numbers and, and ideas that we've thrown up today that, no one can grasp all that, I think, in one call here. And certainly there's going to be some questions and some follow-up. But the idea, I think, when we look at the value proposition for an investor and an owner, is to make sure that you're working with someone. Now, obviously, if 90% of the acreage in the US is insured with a federal crop insurance policy, there's probably a reason for that. And we talked about the subsidy, but we also talked about the guaranteed revenue component that allows. And so certainly that's a unique situation in a business or an investment sense. I think the idea is to make sure that you're working with someone who can navigate that for you and help you come to the proper decision. And, everybody's a little bit different on how they want to approach their own unique, risk reward or input risk type of a situation, Dave. But, working through people's company and working with the land managers who have the access and the training on these tools to be able to know that, hey, someone's got my back and we're going to look at this in a holistic manner. And this is one piece of a building block of an overall investment and strong, return or strong, structure of how we're going to operate our business. But certainly it's the foundational piece and the starting piece, I think, for a number of farming operations, if really not all. And so that's the message that we want to do. And just to, you may not know everything about it. I don't know anybody outside of the industry who really does, but having said that, make sure you're working with somebody who has a very strong understanding of it and knows how to fold that in with the bigger goals that you're trying to accomplish on your farm.
Yeah, I appreciate that. And I forgot to mention earlier, we made it through, Dave and Katie, without any internet connectivity issues. They had some weather come through overnight this morning in Illinois, and they've been sort of bouncing around trying to figure out where to get connectivity. So we kind of had success on that front, at least.
Yeah,
So
I mean, it doesn't rain for a month and a half in Champaign. The day that we want to record, we get a thunderstorm that knocks the internet out. So go figure. But
no crop insurance for that.
Dave. So
yeah, excellent. Well, thank you both very much for joining. And any of the folks listening, if you want to reach out to me, feel free. And we look forward to talking to folks a little bit more about their long-term strategies and where we might be able to help on the crop insurance front. So thanks everybody for listening, and thanks Dave and Katie for joining.
Thank you, Dave, and thanks for allowing us to spend some time with you today.